Well, hello, everyone, and welcome once again to another episode of the 360 Experience podcast and my conversation with Scott Rerucha. Now, I just want to tee this up by telling you, you're going to be blown away by this episode. I've never had someone come into this platform and talk about loan products before. It's never really occurred to me. And also, a part of it is that you all have access to essentially the same products for the most part, depending upon what platform you're working off of. But you don't have access to this product or this suite of products that Scott is going to talk about. A little bit of a background on Scott Rerucha. We met about 13 years ago. I guess it's been 14 years. He actually was one of 4 clients that attended my very first retreat in Costa Rica back in the calendar year of 2011. And we kind of drifted apart, and I hadn't talked to Scott for quite some time, and he reached out to me about 6 months ago, and we've reconnected, and I immediately realized that I needed to have him on this show. Scott brings a tremendous amount of knowledge, but we're going to talk about private lending and how you need to have private lending in your arsenal. Do you know that 25% of all loans funded last year in the United States were privately lended? That's a huge statistic. And if you don't have access to that kind of money, then you're literally limiting yourself by 25% of the opportunities. But it's actually much deeper than that, because there's so much that you can do when you have private lending as a part of your offering. And I know from personal experience, and I'll talk about that in the episode and tell you a little bit of an autobiographical story. Before we get to my conversation with Scott, and you better be ready to take notes because I think your mind's going to be blown by this episode. I just want to say thank you for those of you that are subscribers to this show. If you're not a subscriber, please subscribe. That's exactly how I get people like Scott on the show, is by having a large subscriber base. Give us a like, forward this on to somebody else that you may know that's a work colleague of yours that would benefit from this episode. By the way, this is also a great episode for realtors to listen to, because what Scott offers is not just for loan originators, it's for realtors and builders as well. Now, our sponsors of this show are Leadership 360, and in particular, my signature program. We are accepting applications for people. We only take 12 clients a year. This is the only private coaching that I do as a profession. It is a very unique and incredible program. And if you're interested in applying, click on the link in the show notes below. You can fill out an application. We'll set up an interview process, and we'll evaluate and explore possibilities together. Also, this episode is sponsored by the Loan Atlas. Scott, man, it's great to have you on the show. I mean, first of all, we go way back, and for you to have kind of come back into the picture in my life has been really nice. As I said in the intro, we met many, many years ago at my very first Costa Rica retreat. And boy, a lot's happened since then as it relates to my coaching career. And a lot's happened in your life too. I mean, back then you were the owner of a mortgage banking operation, and now you're still in the business. But maybe you could tell us a little bit about what Legacy does now. And then what I want to do is kind of rewind a little bit and just have you take us a little bit through your history in the mortgage space.
Sure. Well, first of all, Tim, thank you so much for having me. It's always great to reconnect with you. It's probably been way too long. So I'm excited to be here, and always love chatting with you.
Thank you.
I have a company called Legacy Group Capital, and a lot of people would think of us as like a private lender, but we're far more than that. And our platform is really unique. And really what we're doing, and I know that we'll digress into my background on how I got here, but we have a platform where, we are a private lender. Some people, would relate that to a hard money lender. But the difference is that we're doing it on both what we would call the business purpose side, which is we make loans to builders and developers and fix and flippers like most hard money guys do. But the other piece to our business that's really unique is we do consumer lending as well, from what I call a private portfolio standpoint, which means that we can do bridge loans We can do rehab loans for somebody that is going to fix a house and go move into it, or custom construction loans. And it's a big segment of the market that we serve right now. And so, we team up with lenders, we team up with real estate agents, and just help them close way more transactions with true portfolio lending. And, I got to tell you, you and I have been in the business a long time, but the reason we're having so much fun is I really look at what we do here as common sense lending. We don't have 25 boxes to check. We take a look at a loan for what it is, and we make decisions. And that's the fun part of what I do today.
Very cool. So, spoiler alert. I mean, one of the reasons that I wanted to have Scott on the show was because I have a little bit of history in this type of business. When I was an originator, I used to access some private money, and some of it actually was just my own private money, to get creative and to make deals happen. And deals can open up the doors to relationships. And that's where these types of products and having access to them can be incredibly powerful for you in the growth of your business. And he and I are going to get into that in just a moment. But before we do, just give us a little bit of a background at 50,000 feet. How long have you been in the industry for, and what led you to doing what you're doing now?
Yeah, awesome. So my background started, I came out of college and, got into lending, and I was a mortgage guy. And, I went out and kind of became a top producer doing mortgage loans for a bank. And then I went on and I managed a group at a bank and became a loan manager. And I really had aspirations to, grow and build the business a lot. And after, this is 30 years ago, after about 8, 9 years as a top producer in the industry, I decided to go out and open my own mortgage brokerage operation. And so I started my first mortgage brokerage operation in Seattle, Washington, and built and grew that up and converted it from a mortgage brokerage operation, which was really popular back in those days, to the new thing which was a mortgage banker, which there weren't very many of those in those days. And so we converted it and then built and grew it. And I ended up selling it to a bank. And I ran it for the bank for about 3 years. And then my career kind of took a different turn. After I had sold my company and I had fulfilled all my obligations to the buyer of my business, 3 years later, I wanted to do something else. And so I went out with a group of 4 guys, and we started a new de novo bank. And the goal was to start a bank and put a mortgage operation alongside of it. And, back in those days, one of the really neat things about having a bank, once you have a bank license, you can borrow money at a 0.5% cost, as opposed to a mortgage banker when you're going out and getting lines of credit and you're paying, prime +2 or whatever it is. When you have a banking license, it allows you to borrow at very cheap rates. And so anyways, we built a commercial bank, a small commercial private bank, and I also had a big mortgage division off the side of it. And we built that up over 5 years. It was one of the fastest growing banks in the state of Washington. And lo and behold, after 5 years, the model was so great that a big bank named Washington Mutual came in and bought us up lock, stock, and barrel. And so the cool part for me in my career was not only did I understand mortgage lending at that point, but I understood banking, I understood commercial lending. So it really gave me a kind of a diverse field between all the kinds of loans that were out there. And from that point on, I went and I decided to start another big mortgage banking operation, which I did, which was called Legacy Group. And I began building that up. And I wanted a unique platform off of that business. And so instead of having a bank attached to a mortgage company like I did before, this opportunity was, let's start a mortgage banking operation and let's attach a private lending company or a hard money lending company to it. So, we're doing 500, 600 mortgage loans a month, and you have 50 that you can't do because of some reason that doesn't meet secondary market guidelines. So if you start a private lending company and you raise some money and you do some private loans, out of those 50 loans a month that you can't do, there's like 2 or 3 that are really good loans that are really quality that just don't fit the boxes. So we started this private lending piece and kind of ran it alongside a mortgage company. And what brought me kind of to this space is back in 2013, 14, I ended up selling off the mortgage company. And I was fascinated with this private lending piece because it was so fun and so unique. And it was really, again, common sense lending. And, me and myself and a couple of my partners had been doing some private loans, no different than you, Tim, probably, out of your back pocket, just making some loans. And I had been doing that for years myself. So I understood a little bit about private lending, but now we were going to really formalize it. And so I had opened this entity called Legacy Group Capital, which was the private lending firm that ran alongside the mortgage company. And I decided to take that and make that a lot bigger. And so that's where I'm at today, is that we have a private lending company that we do both consumer lending and business purpose lending, meaning that we're lending to both builders and real estate investors on one side, and we're also lending to homeowners. And we're one of the few in the United States of America that actually can say that, because we maintain our consumer lending license, and most private lending companies don't do that. But where we're even more unique is 60% of the loans that we make go to builders for spec construction. And so we're really good at construction. And we also brought in a real estate team of individuals that understand how to find small, developable residential real estate for builders to build on. And what this team does is we source real estate deals, we break them down and find out, we have a little piece of dirt, say in the city of Seattle, and somebody can build 4 townhomes there. We actually break it down. We understand all the code, the zoning for the city, and we put together a pro forma and a site plan. And we actually deliver deals to builders that are ready to build on. And then we come behind and we do all the lending with those builders. So we have this really unique model. We have 10 guys in our real estate department that are very good. Some of them have worked for the city for 20 years in the permitting departments. And so we provide this extra service to builders. Not only are we going to lend you, we're going to find you your next deal. And so what it's done in the areas and the markets that we serve is we have builders that are very closely held to us because they're looking for deals. And the last part of this, on top of the whole lending piece, is that we will partner with builders on deals too. So if builders maybe lack a little bit of equity, they don't have enough equity to put into their deal, my company Legacy will come alongside, and not only will give them a construction loan, but will provide part of their equity on the deal and become a partner with them. And that is something that is happening around the country, but in very few places. There's not a lot of people doing it. And the reason we can do that is because we understand real estate and construction very, very well. And so you have this really unique platform. And the last piece, Tim, I would tell you is, lenders, we serve lenders because having this unique lending platform, there's things and deals they can close that they couldn't close otherwise. Your average mortgage lender doesn't really know how to put together a spec construction loan for a builder, but we have lenders that bring us builders. We put the spec loan together. We can even pay a referral fee out to the lender for bringing it to us. And then the lender is the preferred lender when they build 5 townhomes and they're going to sell them off. And that mortgage guy not only got paid on the spec loan, but he also is a preferred lender on the way out. So we do a lot of stuff with lenders. And the last piece is real estate agents love us because we will buy probably about 200 to 250 properties per year, spend about $300 to $400 million on buying real estate. So we're a buyer of real estate. And when we take these pieces down, we typically assign them to builders, but we are a buyer. So, we serve real estate agents, we serve lenders, and we serve builders. And that's our ecosystem. And we provide a lot of services.
So that was a lot of information, and I'm really glad that you laid down that foundation. And what I want to do at this point is I want to kind of, for pardon the expression, dumb it down a little bit, okay? Sure. Because what I don't want to take for granted is that the listener understands the mechanics of some of the things that you just described. So first of all, this is one of the reasons that I wanted to have Scott on the show, is to have a discussion around the subject matter of alternative types of financing. Most loan originators that are in the market today don't have access to the type of money that Scott and his company provide, but they also don't have the knowledge of what to even look for. So I want to talk about some different types of scenarios that loan originators, which is the predominance of the audience that listens to this show, although I'm sure that it'll be forwarded on to some real estate agents as well. Yeah. But I want to discuss some examples of some types of things that originators can do to add some loans to their pipeline that maybe they don't even know that they can do if they were to have access to this type of money. And we want to talk about a little bit of non-QM too. So I'll tee that up by saying that a quick little autobiographical story was that there was a period of time in my career where I was running into the situation where have a past client, let's say, or a client referred to me by a real estate agent that wants to buy a piece of property, but they don't want to write a contingent offer and their property is listed for sale and there's no guarantee that it's going to sell in time, but they've got plenty of equity in the property. And this is a very typical bridge loan structure, right?
Yeah.
I mean, but there weren't a lot of lenders back then doing bridge financing. And what I decided was, well, hell, I've got some money just sitting in a bank account earning, 2.5%, 3% or whatever it was at the time. I could not only earn a little bit of money by making a private bridge loan on some of these deals, but more importantly, I could capture new relationships. And I want to, so that's an example. So I'd make $100,000 second on this person's, a house that had a CLTV with my second of, 70%, properties on the market. I mean, not a real high probability I'm going to get hurt. And I never did, thank goodness. And I closed 5, 6, 7 loans. I don't remember exactly how many that I would have never been able to do. And more importantly, I impressed the agent by being able to have access to some unique money and some unique financing. So let's talk about, just give us 2 or 3 different types of scenarios that you see loan originators that partner with you doing to be able to capture more business and, more importantly, capture relationships that they wouldn't normally be able to turn the heads of the real estate agent or the borrower on.
Yeah, great point. And Tim, as you know, I've worked with thousands of loan originators and have trained many over the years. But what I believe is, there's a few things that go into really building your business and being a great originator, which is partially it's building relationships. So being good at what you do, you have to have a good platform, but also you have to have something unique about an offering. And if you have all 3 of those, I mean, then you're kind of a winner, right? And I think we offer that third piece, which is here's some unique product offerings. And we could talk till midnight about these because we have a lot, but I'm going to give you some ones that are really good and a little bit different. You had mentioned the bridge financing. So there's bridge financing out there, and usually, what happens with bridge loans, and the reason some of them can be challenging to get through is because with some programs you have to qualify with the original payment on your mortgage. You're getting a second, and then you're going in and buying a house. And with a number of bridge loans, you have to qualify with all the payments, or you can't get them, or it's not really a sellable type of loan. We're a little bit different. We underwrite loans, so we'll do bridge loan transactions, but we underwrite them to what it's going to look like at the end, assuming that a person is going to sell their house. So you don't have to qualify with all of the loans. We want to understand that at the end of the day, we're assuming you're selling your property. And once you sell it, you have to be obviously qualified for the end loan, but we're not qualifying people all the way across the board. But here's where it gets even more unique. A lot of times people believe they have enough equity in their home to do a bridge loan. And then when they get appraisals, wow, there's not quite enough. A lot of the lenders out there will give you up to 75% on your home to put into the new one. And that's what you can kind of bridge to get the new one. Sometimes you're at 80%, sometimes you're at 85%. One of the things that we do, and this works for loan originators, is you have a guy and he doesn't have quite enough equity in the existing home to bridge it against the new home he wants to buy. But he does have a couple other rental properties out there that he has quite a bit of equity in that are sitting there that he's had for years. Maybe it was his first home that he's now rented out. So we have the ability to go in and cross-collateralize multiple properties to get him a bridge so there's enough equity to put down to close on this deal. And then, of course, when he sells the house that he exited, everything gets paid off and he gets an end loan and we all go down the road. So that's something that banks just simply don't have the ability to do. They don't understand cross-collateralization, and they certainly don't bring it into their repertoire.
So let me ask you a question about that. So what prevents you from a risk perspective of that person after the bridge loan closes, taking their property off the market and renting that property out?
Yeah, it doesn't. Normally, they're signing an agreement on our bridge loan that they will list the property for X amount of time, and usually what we see on bridge loans is because people are carrying multiple loans. They want to get out of them as quick as possible. They're pretty motivated because they don't have all these payments. So seldom do we get a guy doing what you said. It can happen. And when we're underwriting a deal, if we feel that might be the case, we're going to underwrite it to, hey, can this guy refi out on his existing property that he left and get a long-term loan and, keep it as a rental house and have a mortgage? So, we understand mortgage lending and underwriting the secondary market. So we underwrite these deals all sorts of which ways. But the more typical case is I've got a couple, they just happen to find this house that came up for sale down the street. They know they're not going to get it if they don't go right now. They can't buy it contingent. And so they're in a hurry and we qualify them for the bridge loan. And so they're really usually very motivated to sell the other property. It's not that your scenario can't happen, but we don't see it very much.
Okay. So before we continue with some other scenarios, I think it's a good time to talk about a couple of things just for the listener's perspective. First of all, what states do you currently lend in, and what states? I know you're in the process of expanding. If we turn the clock forward 12 months, what states would you be lending in at that time?
Okay, so today we are in Washington, Oregon, Idaho, Utah, Texas, Arizona, Colorado, Montana. And then we are expanding that, and we're in the process for California and the Carolinas, and so those are our key states that we have thought that our product would do really well in.
Well, I have a lot of clients, as you know, for my Leadership 360 program, and these are some of the best loan originators in the country. And you just checked off a lot of boxes of states that they are in. So I'm going to make sure that they reach out to you, because to have access to this type of money, I can't emphasize enough. Going back to my story, I would say to clients, I would never let the client in particular, or even the realtor, know that the money that was being lent for the bridge loan was my money. I wanted to kind of keep a distance from that, because I don't want a borrower to come to me with a sob story 4 months later and say they can't make their payment and they want me to cut them some slack and all of that. And I don't want to be the bad cop. I want to be the good cop, right?
You don't want to be foreclosing on anybody.
Exactly.
Yeah.
But the scripting would sound something like this. I would say to potential real estate partners that were representing the buyer in the transaction, I'd say, listen, this deal can't get done the way that you want it to get done. I have bad news for you. Nobody's going to get this loan done. However, I've got access to some private money that is very unique. It's a special relationship that I have that nobody else has. And I'm the only guy in this county that that can get this deal done. And I will get this deal done for you. Let me tell you how I'm going to structure it and how we have to work together to make it happen. So I'm positioning myself to be the hero. And I would say, I'd like to do business with you going forward, not on just these types of obscure scenarios, but I'd like to do business with you on all the transactions that you write offers on. And I intend to show you over the course of the next 45 to 60 days when I perform that, I'm really good at what I do and I'm a good partner for you to have. And, some version of that is something that the listeners right now should be thinking about. Like, what if you had that in your arsenal? What if you had the ability to execute on things that nobody else that they knew could execute on to capture a business opportunity? So the next question, let's go to another scenario. Paint another picture for us of a loan structure that a loan originator that works with you would have access to that they wouldn't be able to get anywhere else.
Okay, I'm going to give you one, but right before I do that, one really important thing to understand, most lenders out there, mortgage guys, they understand a little bit about private lending, hard money lending, and they probably have somebody that does it that they know. Most are connected to somebody, but this platform is really different. And I want to tell you the biggest piece, and this is a little part of our secret sauce that I'm going to share with you right now, is I spent 15 years raising money from private investors. So we have right now $500 million of mom and pop's money that we went out and organically raised money that went into these real estate funds that we can lend money out for. So we've raised our own money. And then we have bank money too. So we're heading towards $1 billion of our own money. And Tim, what I want you to think about is when you were making your own loans, you could look at a loan and you could decide whether it was credit worthy or not. And if you wanted to do it, and you certainly wouldn't do a loan that you didn't think was going to perform. But we've all seen lots of loans that this is a good loan, but nobody will lend on because it doesn't fit 5 boxes or whatever it is, right? And so the reason this is important is most other hard money lenders, they go out and they raise institutional capital. And they get 50 million here, 100 million there, and they have to go put it on the street, and they're going to do bridge loans or construction loans. But they're at the whim of the institutional investor, meaning the institutional investor is telling them what they can or can't do. We have organic money. It's like mine and your money out of our back pocket that we can make decisions on because it's all organic. We have no institutional dollars. It's all been raised by individuals, and they say, take care of my money, give me a return, and do what you're going to do because you do it best. So when I start talking about cross-collateralizing things, and you couldn't do that with a regular private lender because the institution doesn't, they're afraid of that. They're similar to a bank they don't understand, where literally, if I want to make a loan tomorrow and I don't have an appraisal, I can do it. There's nobody to stop me. I mean, we have our own money. We can make our own decisions. So some of the things I'm sharing with you today, when you go, how can they do that? It's because we get to make our own rules, which is really what's fun. So to give you a really unique, I'm gonna take this a little different here on a type of loan that will show you the uniqueness of what we do. So you have a lot of builders out there that are building spec product, and you might have a buyer that finds his house and it's 50% built. And they go to the builder and they say, wow, I'd like to buy the house. And the builder says, well, that's great. You can buy it, but I'm not even finished with it yet. So, if you want to buy it, I'm going to probably charge you a premium or something for it because I want to get it finished and put it on the market and see how much I can get. And I'm only halfway there. We have what's called a mid-construction loan. And again, you won't find banks that are able to do this. And so a buyer can come in and they can buy a house 50% complete, take it off the builder's books so it leaves the builder's balance sheet, and he sold the house and you get to pick out your carpet and your cabinets or whatever, and it turns into a custom construction loan for you. So we're lending to the buyer. The builders like it because they've sold a house, and also they're getting their loan paid off so they can go do another deal. And also you're getting a client because you're doing a construction loan to get it finished. And then as a lender and a mortgage producer, once that house is finished and the construction's done, you get a takeout loan behind it because now you're taking out the construction loan with a permanent loan. And so it's a unique thing. It doesn't work in all situations, but I will tell you we're doing a lot of it right now because there's motivation for a builder to sell a house and to move it ahead of time, especially when he gets to take the debt off his balance sheet.
So a little fun fact, and to support this story,
Yeah.
I don't remember the year, Scott. I'm guessing it was 1999, 2000,
Yeah.
somewhere in there. My former wife was my processor, and Chase Manhattan, which we were brokering loans to, came out with their first construction financing available to brokers. We were the absolute guinea pig. Like literally, my team and I funded the very first brokered construction loan with Chase.
Yep.
But the cool thing about this that I'm not sure that everybody completely understands that you just described is it's 2 loans that you get. So once I had access to this product, I immediately went out to all the local community banks in Ventura County, California, where I was doing business. And I said to them, look, you've got, you do land financing. You've got a lot of people out there who have bought land and you have the land loans on your books. I do construction to perm financing. I'd like to talk to you about partnering if you want to get those loans off your books. If you have a client that is thinking about building, send them to me. I'll get the construction financing that'll take out your land financing. So you guys have more money to turn around and lend because that was their wheelhouse. I would do the construction loan. 18 months later, 12 months later, whatever it is, when the construction was done, I would get the perm loan, so I would get two loans in one. And it was so awesome because I had an
Yeah.
ability all of a sudden to go out. Nobody else was doing this. And I had ability to go out and develop relationships with referral sources, just like what you're describing. So from a loan originator's perspective, what would it be like if you could go out and solicit builders with this product and say, hey, look, here's now I assume that what's happening here is that when the loan originator does your I can't remember what you called it, but basically, halfway built loan that,
Yeah, mid-construction.
mid-construction. So
Yeah.
when the loan originator does the mid-construction loan, what are they doing to ensure that they get the perm loan afterwards? Is that like in any way written into a contract, or is that just something that they have to negotiate with the buyer to make sure that there's loyalty?
No, so what we do is when the loan officer brings us the deal and they have this deal, hey, this person would like to buy this house halfway completed. What we do with the borrower now is coming to us and submitted by the lender. And then we say the only way that we're going to do your mid-construction loan is if your lender has you approved for a takeout on the back side. So without their approval, so they go through the whole process to get them approved. Without that approval, we're not going to do your mid-construction loan. And then the people are tied into them because they're relying on that approval on the backside to get out of our loan, right? And so we work as a team. It's not separated. The whole way we're working together. And I'm not going to say a deal couldn't ever leave and go away because there's no way that you can, but I would say 99% of our deals to the borrower, it seems like a two-step process. It's all together. We've got our perm already approved. We're waiting to see what our rate's going to be. And we've got our mid-construction lender that's in here doing it. And they're both all working in sync together.
I mean, and this totally addresses one of the greatest needs in today's market, which is inventory.
Yes.
So loan originators have a very difficult time right now with the fact that there's just not a lot of inventory out there and that they're looking for ways to create inventory essentially. And within the Loan Atlas community, my e-coaching platform that we have two absolutely spectacular loan originators, one in the state of Virginia and one in the state of South Carolina, who I thought of right away when you mentioned the Carolinas.
Yeah.
And they've done a couple of master classes on the subject matter of developing relationships with builders.
Yes.
And they're going to love what they're hearing right now, because for them to be able to take this, Caleb LeGrand is one such originator, and I've had him on the show. He's a terrific loan originator, one of the best I've ever known. Just to put a little perspective around it, he was in Costa Rica with me about 2 years after you were, and he's been a client of mine ever since. Caleb does a lot of builder business, and for him to have this as a unique offering to offer to spec builders, boy, he's going to be stoked when he hears about this.
Yeah. Yeah. No, it's builders. Let me tell you, Tim, we're our home office located in Seattle, Washington here. And one Friday every month at 7 a.m. in the morning on a Friday, we hold a builder meeting. And we have a big, huge room here, and builders come in and we talk about best practices. We talk about our lending platform. And we have 40 to 50 builders that show up at 7 a.m. in the morning on a Friday to listen to what we have to say. And it's because we're providing extreme value. So any loan originators that bring a builder into our platform and the builder learns about it, we try to keep the loop connected to, hey, here's your lender, and he's bringing you to us, and we're going to provide value, but he's ultimately the guy that brought you in. And, we're going to probably help you find your next deal. We're going to help you underwrite your next deal. And we're going to even invest alongside of you. A lot of these builders need equity partners. And what do builders do when they need an equity partner? When they don't have enough cash and they got a project ready to go, they go to their buddy, or they go to a family member, or they go to somebody to get extra capital. And let me tell you, the builders don't like doing that, because then they've got, Uncle Joe calling them all the time going, hey, when is the development going to be done? When are we going to sell out? When do I get my money back, right? When they can have a business partner that's actually bringing them value and investing alongside of them and helping them, bringing value to what they're doing, it's awesome. And as a lender, if you bring them to this platform, you're just building a stronger relationship.
Absolutely. And, it's interesting because, like, we've been talking a lot in our coaching platforms about the fact that, with a lack of inventory, the place that you need to go is to the people that are creating inventory.
Yeah.
And that's exactly what builders are doing, is they're the ones that are creating inventory. And by the way, you know, if you structure a deal today that closes and you develop a relationship with that buyer, you handle their financing on the midterm construction, you handle their financing on the takeout, and then 5 years from now they decide to sell that house. Guess who has a great opportunity to introduce them to a listing agent? You, because they don't
Yeah.
have a relationship with a real estate agent in many cases. But if you've
Totally.
maintained the relationship, you now control the relationship and the
Yep.
ancillary services that are provided. So give us another example. I love where we're going with this conversation, with just some examples of scenarios that you think
Yeah.
would be valuable for people to know about.
Well, one that I want to share with you, which is near and dear to my heart and is personal because it involves my son. So when my son bought his first house, I'd like to just high level walk you through the transaction that he did. Now, we're tied into a lot of real estate agents here because they're looking for deals for us all the time. And so we found a house that was priced really well. A hoarder lived in it. It was in the Seattle market, but in a good area. But the house was just full of stuff. The guy couldn't list the property. He had IRS tax liens. The IRS was coming in and probably going to foreclose on the guy. And so this was brought to us by an agent. And so, anyways, here's how the numbers worked on this house. And my son, who was 26 at the time, who was making good money, but like most young kids, doesn't have barely anything for a down payment. But he could actually afford a payment, but didn't have a down payment. So he wanted to buy a house. So this house came up. And so here's how this deal worked. And we call this Get Your Kid a Home Loan. And we've named it after this deal that we did for my son. And we've done a bunch of them since then. So we have real estate funds here that investors, how we get our capital is people put money into a fund and then we turn around and we lend it out of the fund and we give our investors a return. And I do the same thing. I put my own money into the funds too. And I have money sitting there. So my son wanted to buy this house. The house, we negotiated with the guy at about $400,000. Okay. The house was probably worth about maybe 550-ish at the time, but he had it full of stuff. He was going to get foreclosed on. And so we came to him and said, hey, if we can close on this in 2 weeks and we'll give you non-refundable earnest money of $25,000 right now to sign the deal. We'll close in 2 weeks. You can get rid of your IRS tax liens and you won't get foreclosed on. And this guy only owed a couple $100,000 on the house. So he's going to get a couple $100,000 out of it. And he said, great, I will sell at that price if you can close in 2 weeks and do all this. So my son, who had an income but didn't really have any money, here's what we did. Legacy, our company, came in and we made a loan to buy this house that we were gonna buy for $400,000, roughly, call it, and we lent him $400,000, 100% of what he was buying the house for. Now, Tim, we're not dumb. We don't do 100% loans. That's not how we work. But I, being his father, had a bunch of money sitting in our real estate fund here in Legacy, and so what we did is we collateralized $100,000 of my money against that loan. So now imagine we give my son $400,000 and he gets all the money. He pays cash for the property, closes on it. But I have collateralized against this deal $100,000 that's sitting in a real estate fund, but now is collateralized to that property. So if anything went wrong, we could go get that $100,000. That's the equity, okay? And then my son wanted to put in $50,000 to fix up this hoarder house, okay, which he did. And so we did our loan that we closed on, we made it a rehab loan. So then we gave him another $50,000 to fix the house. He redid a kitchen and redid a bathroom and did some finishing in the basement. So now the house is done. He's got $450,000 into it. I've got my money collateralized against it. It's all done. And he goes in there and he moves into the house and he lives in the house, for 2 years. Okay. And then he turns around and within 2 years, he has a house appraised that appraises at $750,000. He turns around and sells it the first day for like $760,000. He owed $450,000 at the time, right? And so he just made almost $300,000 on a transaction. And I guess the piece that I missed in there is after we closed our loan and he fixed the property all up, we had it appraised, and at the time that after he did the work, it appraised at like 630,000, and he owed 450. So we did a rate term refinance, and he got a $450,000 mortgage. At the time, it was 2.5%. And which was when rates were at their lowest, and so his payment was super affordable. He had financed the property 100%, and he sold it 2 years down the road. And how many 28-year-old kids have $250,000 to $300,000 in their bank to go buy the next one? And my money got released at the time that we refied it, because when we paid off the original loan, I get released. So it's kind of getting around gift funds and all that. But the best part about it was he wouldn't have been able to refi out of it if we didn't have the $450,000 loan against it, because it turned into a rate term refinance, which you can go ahead and you can refinance out of it. Had he wanted to, if the loan had been less, he couldn't do a cash out refinance. But in this case, because we lent 100%, he could come in and do a rate term refinance as long as the property appraised higher. So this is how my son started. Now he's owned 3 homes since then. This levered him, to get into more deals. And if you're a mortgage guy putting together that interim deal for a youngster to get a house, then you get a takeout loan behind that when you got to pay off the interim loan that got the deal done. And you got a real estate agent that's just going, the real estate agent that was involved in this that brought us the house is like, I've never heard of anybody doing anything like this. This is crazy. But the funny part, Tim, is us as a lender, what a great secured loan. We had plenty of equity because we secured it to a fund with an extra $100,000. So, I'm on the hook a little bit with my kid, but at the same time, what I didn't have to do is give my kid gift funds and then have to try to come back later on and have him pay me back or something like a lot of parents do. And so, my money. Yeah.
So let me ask you a question on that. So let's remove you from the scenario. Yes. We'll replace you with me. Let's say that I bring my son in the exact same deal.
Yep.
That's going to require me to invest the $100,000 into your fund, correct?
Yes.
And when I'm invested into that fund, am I also getting the return that you pay out to other investors?
Interest on your money while it's in the fund.
Oh man. now my mind is blown.
Yeah.
Yeah. So wow. Like, if I'm an originator and I could talk to all of my past clients in my database that have kids that are in their 20s and offer a program like this and say, and I could get you a 10% rate of return that is, pretty damn secure, because this is a fund that's been performing for years, and I show the performer on the fund, and this is a way to get your kid your new home.
Yeah.
Wow. In fact, we may need to talk offline about me doing this for my son. This is I'm really glad you shared that scenario. Wow.
So Tim, one thing that I would tell you too, this just comes to mind because it's happened a week ago. We had a top producer who and he brought in 12 real estate agents into our office because he knew about a couple of these programs, and he wants to get these out to his agents because he wants the agents to understand that he has extra firepower, and he doesn't have quite the knowledge we have on how the inner workings of these all work. So he brought in 12 agents, top agents that he works with, and they sat down in our conference room and we did a little show for them, a presentation on this product and a couple more. They were all blown away, and they're all like, wow, how do we get into this? And, let's learn more. And so one of the biggest things that Legacy's providing to lenders is we do builder meetings and we do real estate agent meetings where the lender will bring them in, whether it's a Zoom, whether it's in person, and we present this stuff, and they're blown away.
So first of all, I'm sure that people are wondering, how do I, people that are in the states that you named that you're already in, the Utahs, I've got quite a few clients in Utah, by the way, as well. How do they get a hold of you? I mean, to talk to you about maybe being able to have a relationship?
Yeah. So we have a department that onboards lenders into our system. One of the things that I would tell you, Tim, is that, I know a lot of the people you work with, some of the top, lenders in the country. And so, the pedigree of the people you're dealing with is very high. One of the things that I learned in this business is that we like to deal with the individuals that are professional, that know what they're doing, that run good business. Because when you get into private lending, it's different than check 20 boxes and you got a loan, or you run a DU and you get a loan. This is like, you need people putting files together well, and they need to understand our platform. And so we approve people on our platform, and not everybody gets approved. It's not just, hey, if you got a loan for us, you get approved. And so we have three things. Lenders get approved. They have to fit our profile. We want to be able to bring them value, and we want them to be able to bring us value. And so part of it is the guys that really run their business well, but also the guys that, there's people out there that, don't understand, say, like construction lending or fix and flip lending, and they don't really want to. Those guys aren't probably best aligned for us. But people that want to learn and grow and build their business and are professional and do volume, those are the people. So we have an onboarding system. When we come in, you get approved as a lender. We also approve real estate agents. So we don't do business with just all real estate agents. They get approved because we want the agents that understand our platform. And same thing with builder. So we have approved list of these people that come in and that meet the profile. And once they use it, those are the people that we continue to grow the business with. But we have a whole onboarding system of how we onboard. And for originators, it would be, here's how, we like to see files come. Here's the kind of stuff we do. We have all sorts of training because, Tim, we're talking about concepts that a lot of lenders haven't really got their hands around. So there's a fair amount of training that goes involved so that we're not wasting our time.
Yeah. You don't want to work with somebody who's just going to throw a file at you that's half baked and then you have to figure it all out. Like I totally get it. Okay. So you got me curious.
Yeah.
Do you mind sharing who the loan originator was that brought in the 12 realtors that you said I know?
Oh yeah. Do you know Dan Chapman?
Actually, I don't know Dan. I don't.
Oh, so he's an old legacy. I thought you did, but anyways, he worked with Drew Nickel and a bunch of the guys that you know Kirk and all those guys, and so, but Tim, this happens. Like I would say that we do these presentations almost one a week to either a group of real estate agents or we do lenders too. Sometimes we have one office that we do a lot of the top producer of Guild, and he has a handful of originators. We did a meeting for him and his office, and they're all blown away. And they immediately start sending deals, but we have to train them as to, because the minute they hear common sense lending, they start throwing stuff at you because, I think this one will work. And we can't weed through all that. We got to train them on what we're looking for.
Exactly. That totally makes sense. So a couple of questions. First of all, what do the rates look like on something like this?
Yeah. So the rates are usually, they run between, like today, I'm going to say our rates go as low as on owner occupied, like bridge loans are in like the high 8%. And our construction loans go all the way up to 10 to 11%, depending on the kind of deal they are. The riskier the deal, the higher the rate, but our rates are not like exorbitantly high. But why people use us, I sit down. I did a presentation for about 150 real estate agents about a month ago, and it was really funny because I asked the agents. Most agents, they hear about hard money lenders and they don't really know how it works. And I tell the agents, the first question we ask the agents is, so how many of you have closed a deal through a private lender or hard money lender in the last like 6 months? And raise your hand. In a room of 150, there's probably 4 or 5 hands that go up. And I said, do you know that 25% of the real estate transactions in the United States of America close through a private lender? And so I only saw about 4 hands go up. So do you understand, if you're trying to grow and build your business, that there's many people in this room that are missing a whole segment of the market just because they don't understand it? But I will tell you this, I'll use the city of Seattle. The top agents in the entire city or the state of Washington, they know us and they use us because there are transactions that have to be completed like that. And so it's just super important that these pieces that we're providing, if you want to grow your business and differentiate yourself, that you understand how they work. But it's a lot to get your hands around. And so agents thrive off of this stuff because most of them are looking for something different and unique. And I'm sorry, you asked the original question. I might have deviated from that.
No, you answered it. What the rates were. And those are very favorable rates. I mean, loan originators were selling conforming 30-year fixed rate mortgages at almost 8%, not more than about 9-10 months ago. So, that's not even that big of a jump.
Yeah. So Tim, I got to just tell you this one other quick story, and this just happened a couple of weeks ago. But back to your rate question. Our value proposition, I don't talk too much about rates because we have so much value proposition, but our rates are competitive. So don't get me wrong. But we had a agent and a lender that brought in a builder. So the agent works with the lender, and the agent has this builder, and so they all three came in together. And they said to the builder, you need to come in and see what these guys are doing. They have this cool platform and they lend money and they do all this stuff, right? And so they bring him in, and I was one of the ones meeting with him. So I sat down in the room, and it's this young guy. He's about 35-year-old builder, and he probably closed a few deals. And he was a little cocky, and he had his baseball cap on backwards and everything. And so he sits down and he says to me, he says, hey, my agent brought me in here with my lender, and just so you know, I borrow from this guy named Bill down the street, and he's an old guy, and he lends me money, and I don't really have to put up with a bunch of junk. And so, I want to save you a lot of time, Scott. I don't want to waste your time. So, I like Bill a lot. So really the only thing that's important to me is like, what's your rate on your construction loan? Because I know that you do construction loans to builders. So what's your rate? And so I look at him and I go, it just doesn't matter. And he goes, excuse me? And I go, it just doesn't matter. And he goes, well, it matters to me. And I go, not when I'm done telling you what I'm about to tell you, it won't matter to you. And he goes, well, I don't know what you mean. And I go, let me ask you this. What door could you walk into where somebody not only is going to give you a construction loan, but they're going to probably find you your next dirt deal. They're going to break it down and do all the due diligence for you. They're going to deliver you that property. They're going to permit the project for you during the process. And they're going to give you your acquisition loan to take it down. And once the permit pops, they're going to do a construction loan for you. And if you're short of money or cash to close on the deal, they'll invest alongside of you. And by the way, if you don't have a back office, they're going to help you do your project books, because a lot of these small builders don't have back offices. We'll run your project books for you through the company so that you know where you're at all times. And we'll do all that for you throughout this process. Where are you going to find that? And by the way, Tim, we do right now, we're running about 150 sets of books for builders on projects, just to let you know. We have a whole accounting department that does that. And we do that because we like to keep on top of the deals and help the builders get through them the right way. So we provide a lot of services. But this guy looks at me and he goes, do you do that? And I go, yeah, that's what we do for builders. And he goes, well, how do I get in the system? I go, well, you're going to have to fill out a builder package and get approved with us. And he said, where's the package? And so we got him the package. He said, I'll have my package in tomorrow. And the agent was all happy because they're sitting there, and this builder's all fired up because he thinks the agent's brought him to this great place. The lender's happy because he brought the agent here, right? And now we're like kind of all kumbaya together, right? And this guy gets all fired up. He says, Scott, I'll have this back to you tomorrow morning. He walks out the door, and I look at the agent and the lender and I go, he never asked about rate again, did he?
Okay. So another question.
Yeah.
There are people that are listening to this that are very intrigued, I would have to imagine.
Yeah.
And you're doing a great job of providing a ton of value in this conversation. So thank you. The question is that if I'm a lender that isn't in one of the states that you currently lend in or that you plan to lend in, where do I go? Like, how do I find something similar to this? Is there anything else out there? And even if it's not the full suite of offerings that you're talking about, let's direct the listener to some places they can go to get access to some of this type of funding.
Yeah. So I think what's super important is that what we find is bridge financing and construction financing, which would be custom construction and bridge loans. So these are to like consumer loans to owner occupants. Those are two super important things that you almost have to have in your arsenal. And if you don't, you're going to lose deals because somebody else will. And so there are private lenders in every community that will do construction loans. And so what you need to source out is that there's going to be very few that maintain what I call the consumer lending license, and they're able to do an owner-occupied loan. A lot of them will do loans to builders and do loans to real estate investors. That's easy to do. Most of them don't want to deal with the compliance around consumer lending, so they don't have their license. But there are ones that do, and you need to seek those out in your state, because those are usually the guys that people don't know that much about. And here's the thing. Those guys that are doing consumer lending, in the state of Washington, we're like the only one. I've not found anyone else that does it. And so who we compete with on the consumer side is banks, because banks will do this. So banks will do bridge loans, banks will do custom construction loans, right? The problem is all the red tape and all the guidelines and everything that they bring with them makes a lot of those loans unattainable for these borrowers. So if you can find, you got to do a little research and find the people. There will be a few people in these states that are doing consumer lending for bridge and custom construction. I think those are two of the biggest products that we do to the lenders that serve us. Those are two of the biggest products. The other side is find a really good flexible hard money lender that is really has a good reputation in regards to small to mid-sized builders, because those guys you can team up with and you can bring builders to them. And if they're good, builders will appreciate it. And then you can be the guy that's setting up financing through this private lender. And ultimately what you want is you want to be the takeout lender for that project. So a guy that's building an 8-home plat, you want to, be the preferred lender on that plat. And that's how you get to do that. And so, we can help you more if we're not in the state on how to identify and find those people. But there is there's a little bit of research and time that it's going to take to do it. But you need that.
Yes, you do need it. As technology advances in this industry and artificial intelligence in particular starts to perform certain functions that an originator in the past once performed, and margins shrink as it relates to the commoditization of the A paper, vanilla, 30-year, 15-year fixed, 20% down, that kind of stuff. Originators need to start diversifying. Now, there's an originator. I want to go to our final subject, which is that of non-QM, which I know that you have experience with that and do a little bit of that. So there's an originator who I introduced you to via text. I sent you his contact information. His name is Justice Roberts, and I had him on the show about 6 months ago now, and he's a friend and a client of mine in the L360 program. When he was at our business and life planning retreat in Costa Rica a little over a year ago, about a year and 3 months ago, he had identified that what he wanted to do was to really become a master of non-QM. And someone may say, well, what does that mean to be a master? Well, it's a different product. It entails a higher interest rate. It's a different marketing strategy. It's a different sales presentation. It's a whole different vertical of the business. If you want to be good at it, you need to know how to sell it. You need to know how to source it. And you need to know how to position it in a strategic way. Justice Roberts had his best year in the mortgage business in 2024. He closed some monster deals that nobody in his community could close because he knew the product, he knew how to position it, he knew how to get away from the conversation of rate and get into the conversation of the long-term benefit of doing the deal. He's a great guy for you to know, by the way, and somebody who I think will be a perfect fit for your platform. What I want to talk about is the importance for the listener of understanding that the time is now to find a niche and to niche. I don't know. I mean, everybody calls it something different. We'll go with niche. Right. It's important to have a niche. It's important to have these things in your arsenal, as you said, that others don't have. So let's talk about non-QM for a minute. Do you guys do non-QM, and what advice do you have for originators on how to learn to sell that product?
Yeah, so we kind of overlap a tiny bit on non-QM, but let me give you back to your whole, how do you sell a higher rate on a unique niche product, right? Like that's really what we're talking about here, and what niches do you fill? And so for me as a lender, you have to have everything, right? And so there's products that, what we don't do is like a bank statement loan or something like that. But we what we would do is, somebody else might qualify on a bank statement loan for a certain product, but we'll just take a look at the loan for what it is and decide if we want to do it without having to check or meet any boxes. But what I want to go back for a second back to your whole rate thing, and somebody that hears, oh, I do non-QM, or my rate's like 2% higher or whatever. When we first came out and we were doing consumer lending for bridge financing or construction financing, this is now 15 years ago. We didn't really focus and we didn't do very much because I'll just use a custom construction loan. We did them for owner occupied, but who's going to come to us for a construction loan when we're charging 2.5% higher in rate than the bank is charging. And it was a big enough spread, especially on bigger loans, that somebody's going to say, I mean, I know it's a little more of a hassle to go through the bank, so I'm going to go through the bank and put up what I have to put up to get that loan, as opposed to going into this kind of portfolio product or this non-agency product. So we didn't do a lot of it. We didn't focus on it. What's happened over time is banks have become incredibly tight guidelines. And I mean, Tim, from when you and I started in the business, it's a whole different lending world in regards to guidelines and how deals are underwritten and everything. But my point is that I want to share one more loan with you that is super important, that explains this point exactly. We had a couple that wanted to build a house. They are a Microsoft couple, and they made really good income. They were both vice presidents at Microsoft. They had great income. They had $10 million in a brokerage account. Okay. And they needed a $6 million construction loan to build their dream house in Medina, Washington. And they had bought a house there for a couple $1,000,000, and they had ripped it down, and they were getting ready to build their dream home. And the issue was this, is that they had been with two of the big banks. I won't mention their names, but you would know them. And they had applied for a construction loan to build this $6 million house. Now, once you get over a $3 million construction loan with any bank, they really start to seize and tighten up on, it's a big loan. They don't like construction loans, all this stuff. So these guys were, for 90 days, going through a process with two banks to get a loan to build their house. They have $10 million in their brokerage account. They own the house that they bought free and clear, and they had ripped it down, and they're ready to break ground. And 90 days in, they have no approval from either bank. Okay. And I get the call from them. Actually, I should say it was the lender that was dealing with them that had taken them to the banks. He gave us a call and he said, I have these clients, they've been with a couple of these big banks. They can't get their deal done. They're ready to break ground in 10 days. So he brought the deal in. We took a look at it, and the people asked me the question. They said, Scott, can you do my loan? I'm ready to break ground in 10 days. We don't want to hold this thing up. And I said, here's the good news. We can do your loan. Here's the bad news. We're going to be 2.5% above where the bank loan is. And they said, I don't care. Let's go. Can we go? Can you get this thing approved, and can we go? And I said, yes. And so these guys came in, and by the way, they already had two appraisals on the project when it was going to be completed, and they were both right around $12 million is what the value was going to be on the way out the door. So here I am making a $6 million construction loan on a $12 million end value to people that have $10 million in their brokerage account, that have perfect credit and great jobs, and neither bank could get these deals done. And now the originator not only gets to bring the deal in and get paid on that, guess what he gets on the backside? He gets a $6 million takeout loan on the backside. And these are the type of unique situations. And by the way, we did that deal in 10 days from start to finish. And we didn't require a new appraisal. I saw their appraisals, right? I didn't need to see another appraisal. Now, most lenders would have said, hey, we need our own. We need it in our name. We didn't need to do that. So these guys didn't care about the rate. And what we're finding today is people want speed and flexibility, especially on deals, to get them closed, to get into the hot market where they need to buy something and close now. And so these are all very, very unique product offerings that are out there. And whether it's a non-QM deal or a portfolio deal, this is what separates you in the marketplace. And it's not about rate anymore. It's about speed and flexibility. And that's
solving a need. It's about solving a need. Yeah.
Absolutely. And so as an originator, when somebody says, it's kind of like my builder story, when he says, what's your rate? It just doesn't matter. That's not what's really important to you. What's important to you is you get that house and you build it. And, if those people would have sat with that bank for another 60 days and waited, that cost them money because, time is money. We gave them a 1.5 year loan. Sure, they're going to pay 2.5% more for a 1.5 years. And then they're going to get a great end mortgage loan that's going to be down at the rate that they want. So for them, it was just a no-brainer. And banks wonder why they lose deals to us. It's because we can be quick and flexible, and that's what these kind of people want. That's what builders want. That's what investors want. And now homeowners want it too, because Tim, you've been in hot markets before. If you can't go now, if you can't react, and if you can't do something now, you'll lose deals.
100%. 100%.
Yeah.
Fascinating conversation. So glad that we sat down together and
Awesome.
had this dialogue. I'm sure that you're going to get some inquiries from some people. We're going to put your contact information in the show notes to
Yep.
this episode of the 360 Experience. Scott Rerucha, thanks so much. I'm looking forward to seeing you in a couple of weeks
Yeah, we're
when I come
excited.
up to Seattle and speak for your company.
Yes.
And it'll be a pleasure to give you a hug. And thanks so much for taking the time to educate today on this episode of the podcast.
Well, Tim, I appreciate it. And as always, it's always great to talk to you. And thank you so much for coming up and speaking at our event. We got a full house. People are going to be pumped to see you. You're going to have a lot of the guys from our neck of the woods that are coming to see you too. So it's just going to be a great time.
Yeah, it'll be a blast. Thank you very much. Thanks everyone for tuning in. And I hope that you have a productive week.